Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, I'm going to talk a little bit about the regional banks and quote unquote cockroaches that are going around, according to Jamie Dimon. As always, is not individual investing advice, just how I analyze stocks. And I'm going to give you a couple techniques that might be useful in this kind of situation, especially if you're thinking about buying any of these banks or other financial institutions too. And maybe if you already own them as well. So a couple of the banks that got mentioned were Western Alliance Bancorp and Zion, but pretty much all the regional banks, usually regional banks trade in one big block anyway. They're not usually too much different than one another, other than some may be more higher quality than some of the others. But the market tends to treat them all pretty similarly for the most part. So it's not unusual to have, a bunch of regional banks sell off at the same time. That's actually pretty normal. But I have a couple techniques and thoughts that will maybe help you as an investor avoid maybe some of the more obviously dangerous ones that might not look as dangerous on the surface. And a lot of this is philosophical rather than numerical, I guess, or kind of math-based or quantitative, because my theory here is, or my approach, my thoughts on this are, we don't really know what risks banks are taking. And if the recent news is any indication, often the banks don't even know what risk they're actually taking. Okay? I don't trust credit rating agencies. I don't trust any of them. I don't trust the businesses they're doing business with. I don't trust the bank's judgment and to stay rational, and to try to get returns and to not take on too much risk. But the basic method I use, so I don't believe anything anybody says, is what I'm trying to say, because I don't think a lot of them know what the risks are, or even if they do, they don't have enough incentives to not take those risks during the good times. So with that background in mind, it doesn't mean they're necessarily bad people or anything. It's just the way that the business is structured. There's a lot of competition on how many regional banks there are, like maybe 3,000 or something like that, or small and regional banks. So there's a lot of competition. And if you're a publicly traded stock, you have incentives to try to really maximize your earnings. And those are very clear to see for the most part. The risk that you're taking to get those earnings is much harder to see. So it's just structured in a very risk-on kind of way. So my rule and as I say this, I'll say I've invested in a lot of regional banks. During March 2020, I think we bought at least half a dozen, and they all doubled within a year or two. So, and then in 2023, I bought one bank during that crisis, mini crisis, UMBF, which I had owned before, and then sold it the next year for like a 37% profit. I had owned it once before, so I was a little bit more familiar with it. I was pretty cautious still then. That was the only one I bought during that kind of crash or whatever. So, but the way that I do this, and here's the real tip for at home. I'm going to use Fast Graphs for this. I do have an affiliate link down in the description for, I think it's 25% off if you use the link and use the code. Other than that, I don't have any affiliation really with Fast Graphs, other than I was a user and I emailed them and I was like, hey, I use your program on my channel all the time. Do you have a discount? And they're like, yeah, sure, here you go. So other than that, I'm not really like promoting Fast Graphs, but it's very, very useful for exactly what I'm about to show you. So there are hundreds of publicly traded regional banks. I've gone through all of them. I've gone through pretty much every one at some point in the last 5 years and just briefly looked at the Fast Graph to see how they did back during this 2008 decline, or financial crisis. And what I'm looking for is there are a couple different things. Some of them basically had earnings that were very high and then have almost never recovered or took forever to recover. Maybe Huntington is one that comes to mind that I get asked about a lot. Let me see if I can find it. I could be wrong here. Huntington Bank. Let's look at that one. Yeah, I think. Yeah. So you can see earnings were what? $1.81 in 2006 before the financial crisis, have never recovered since then. So I've got lots of questions on this one over the past 10 years. Is it a buy? And my response is always, well, their earnings still haven't recovered from 2006. So for me, it's not a buy. And the reason for that is I don't know how much risk the bank is taking. Usually these banks don't change that much from cycle to cycle unless they go out of business. Because a lot of their customers are going to be the same. They aren't going to turn over all their entire customer base because of one downturn or whatever. The ones that survive. So when I look at this, I can see, well, they basically lost, I don't know how many years before, 2, 4, 6. They basically lost about 4 years worth of earnings in 1 year in 2009. So and earnings never have recovered since then. That's, to me, evidence that they have taken on too much risk in the past, and I just write it off. I don't invest in those companies. It doesn't matter if maybe they improved and maybe they run better. I do not give the benefit of the doubt when it comes to banks and lenders and financial institutions. So when we go to Western Alliance, Zion is the other one that was in the news. I think they both reported earnings and reported a loss on, I forget exactly what it was, a commercial loan, I think, that was supposedly fraudulent, or data was used or something. I don't know. Doesn't really matter. What does matter is if you go back to 2009, you can see they lost, what, $2, we'll call it $3 a share. So they lost about 3 years worth of earnings in those couple of years. And then it took took about 3 more years to recover. So about an 8-year period of no earnings. Well, total probably losses during that 8 years. So probably a lost decade, basically. Now, that said, they didn't go out of business. Earnings did recover. But you also see this giant bump during the COVID boom and then decline during the bust. So they do appear to be very sensitive to extremely sensitive to economic factors, and probably interest rates and things like that. So to me, this is already a very risky bank. I would not invest in it. And you can see during these mini crises that the market is telling you it fell 75% in 2022, right, to 2023. That is telling you the market can identify the risk there. So I don't need to go in and try to do any extra work. It's just an avoid for me. So you could look at the PE and say, oh, it's an 8 PE. Maybe it's cheap. Well, you don't know if they're going to be losing money for the next several years or stay in business, right? I'm not saying they're not. I mean, they made it through the Great Recession, but that you can't use PE ratios on deeply cyclical businesses, right? This is deeply, like, they're losing money for 2 or 3 years in a row. That is not the type of bank that I want to invest in. So that one is completely, I don't even track it. It's written off. Zion, which was the other one that was in the news, down 13% yesterday. Pretty similar. I think maybe they had 1 year where earnings finally recovered during the boom here, COVID boom again. Very economically sensitive, obviously. You can now. I don't even look at them because they did so poorly back here. Pretty similarly, actually, they lost 3 or 4 years worth of earnings in a couple during the Great Recession. But again, the market is telling you here, with a 70% decline in the stock price in a year, that it's risky. So whenever the market gets scared, the market knows that this is a risky bank. So if you look at the PE and you look at, they sold off 13%, maybe it's a deal. I saw that these were both trading up today on Friday, October 17th. 8 PE, that might look cheap. it's risky. There's a reason that it's cheap. Now, can I go in and tell you all the details of why it's risky? No, and I am not going to spend my time doing that, because I can look at the history and know that that's enough for me to just avoid it. That's not worth me doing like extra work on. So you can scan through, if you have fast graphs especially, you can go through all the regional banks and I just kick out the one, like I don't pay any attention to the ones that don't have a good earnings history. And there are some that do have a good earnings history. So I mentioned UMBF. Now this doesn't mean that they'll be good in the future. It's not a foolproof thing, right? They can still, all the same risks are still there, but I don't have clear evidence of it as much with the other ones, right? So you look at their history, earnings were pretty steady during the Great Recession. They had kind of this funky peak here with the stock price, but even taking that into account, it lost less money than the wider market during a financial crisis, which is amazing. And during this, so I bought this decline here and made over 100%. And then I bought this decline here and made about, I think it was 37%. I bet this is probably a 50% decline. Yeah. So I probably bought it after a 50% decline. And if it fell 50%, I probably would consider buying it again. It's been pretty good to me. It seems like a decently run bank. And since these regional banks tend to trade similarly, if the other regional banks get crushed, that could send UMBF down 50%. It's still risky, but you have 100% upside potential if they can get through whatever the problem happens to be. So, I mean, if you bought, let's see, if you bought back here in 2009, I don't know, let's see, and you held until this, is that 5 years? 1, 2, 3, 4, 5. You held 5 years. You would have had an 80% return, almost 100%. So I usually aim for a 100% return within 5 years if I'm buying a pretty cyclical stock like this. But I only want to buy the good ones. And I've been very cautious on banks since 2022, basically. The fact that I bought this one again is a little fluky. Like, I just didn't want to seem like I was too scared to buy them. I did own Signature Bank, and I did not use. I can't show their chart because they're bankrupt. And I sold all my other banks basically except for that one. And it was one of the ones, even as cautious as I am, I didn't have like any kind of crypto exposure or anything like that because I'm not really into crypto, but I saw that they were attracting more business because of those clients. And they were basically the clients, I think, that fled, that caused the rush of capital out of the bank. But they had a good track record overall, and they still failed. So I don't want this to sound like these are perfectly safe, but my overall track record of 7 or 8 doubles with banks is pretty good. So just a couple things to think about. If you found this useful, hit the like and subscribe button, and I'll see everybody later.